All right, welcome back, guys. So here is the very, very last chapter of the entire class, right? So this is the moment that we're waiting for because this is the last concept that I'm going to be teaching you guys, and how we're going to apply it is the exercise is going to be coffee cafe, right? So let's talk about the closing process. Now, as I've spoken to you guys before, from the very beginning of this class, we are going to be taking a look at the entire 10 steps of the accounting cycle. So what the closing process is going to entail is going to be steps 5 all the way to 10. And that's what we're going to be doing at the end of this class, right? I've mentioned for you that we're going to start from step 1 and we're going to gradually make our way to step 10 and complete the rest of this class. So the class is doing the 10 steps of the accounting cycle. However, the last 5 steps usually it's actually a lot quicker than the first 4 steps, because the first 4 steps, right, we've practiced it. We've seen what it's like to have to collect the source documents, determine whether to journalize it or not, and then post it to the ledger. We've done that so far, and we've also completed a few trial balances here and there. Now, don't confuse that. Yes, we've seen examples of trial balances, but we did not complete the unadjusted trial balance. The unadjusted trial balance happens when you completed your full months of transactions, or whatever the accounting period is. Once you reach the end of it, you're going to do an unadjusted trial balance. So it's essentially doing the same thing, right? We run our weekly trial balance, but this time on June 30th, right? That's our scenario. We're going to complete our one and last and final trial balance, right? Once we are successful and both debits and credits match, that's where we're going to go ahead and move into the next couple steps from 6 through 10, right? So as we remember, right, we're going to be doing the unadjusted trial balance, which happens at the end of the given period, right? Our main goal is that we need to make sure that does all of our debits match our credits, especially because now that we've added so much information and so many transactions have happened within the month, that's where we need to finalize and come to a conclusion whether our accounting has been correct. So what we've been doing in the Coffee Cafe was we were doing weekly trial balances to ensure that within the transactions that we did within that week, we didn't make any mistakes here and there. Because again, if you're doing this on a month-to-month basis, you would be super devastated to find out that you forgot one of your transactions and you have to go through a whole month's worth of transactions just to locate your mistake. Now, they've done it before. It's happened many times before. It's good that you try to run your trial balance as often as possible so you don't have to wait till the very end of the month to have to finally do your trial balance to realize that you had uneven amounts. So every trial balance that we've run so far, right, we've always came to occurrence, oh, I don't balance here, I don't balance there, I don't balance there, I'm missing this there. So now we've cleared all that up, right? We're good all the way up to the 21st. So when we run our last trial balance, which is for the 28th, right, that's going to confirm that our accounting from the 1st all the way to the 28th are accurate and that they're complete and we're good to go. Okay, so the unadjusted happens at the end of the given period before we make our adjustment entries. So that's what we have to complete, is to make sure that to ensure the accuracy of our accounting is to verify whether our total debits match our total credits. Okay. Then step 6 is to run our adjustment entries. So if you guys remember way back when we were introducing you to this idea in the first week of class, I threw a bunch of ideas to you saying, well, this is an adjustment, this is an adjustment, this is adjustment. Now that we got to take a look at every single one and we got to go through them, that's exactly what step 6 is going to be entailing. We are going to finally run through our adjustment and make those entries to verify that we either used up an item, spent it, depreciate it, whatever it is, right? So that will include anything such as periodic inventory, right? We will be looking at periodic inventory for Coffee Cafe. We will be looking at depreciation, right? We acquired all of these assets, so therefore we're going to practice depreciation. Supplies expense, right? We'll talk about that, right? Because we purchased supplies. We're obviously, right? We bought business supplies. We don't have 10,000 cups in our lobby anymore, right? Because we sold them along the way. So what we're going to do is we're going to practice expensing them, all right? Getting rid of them, showing in our books that we no longer have them anymore. We're also going to learn about cost of material, right? And then also anything that has to do with bad debt expense. And we will get to practice that today because once again, in reality, if you are allowing your clients, your customers to have the option to owe you money, you have a 5% risk that you may not get that money back. It could be even higher depending on what kind of customers you serve to. So if you aim for low income families, most likely that percentage is really high. But if you're out to the whole public, anybody can have access to your credit card, then it's going to be significantly a lot lower. But yes, we're going to be looking at bad debt expense. So once we run these journals again, right, we're going to do the same thing, right? We're going to journalize our adjustment entries. We're going to post it to a ledger. And then we're going to run a adjusted trial balance, which includes these extra accounts. So again, depreciation has an accumulated depreciation, which is a contra account. Bad debt has, bad debt expense as well as allowance for doubtful accounts. So all of those are going to come into play, and we're going to be inserting those as extra expenses or extra things that we're going to be transferring from our assets into those expenses. So running through our adjusted entries. So therefore, we need to run our last adjusted trial balance, okay? If our adjusted trial balance pans out and our total debits match our total credits, right, where we successfully transfer the exact amount that we're adjusting each account for. So if I'm making an adjustment to inventory, that they pan out exactly even out, all right? So once we deal with that and we are successful with our debits matching our credits, that's where we can start preparing our financial statements, right? So what the financial statements is going to entail is primarily your adjusted trial balance is primarily going to help you produce your financial statements. Okay? Why? For the first one is when we dive right into our income statement, we're picking information from our adjusted trial balance. Okay? Things like sales. So we're going to take our total revenues and we're going to go them against our cost of goods sold, which is directly correlated to inventory, right, for selling items. And then we're going to run it through every single expense that we incurred for the month or for the given period, right? So taking all of our revenues, subtracting out all of our expenses to give us either a positive or a negative number. Positive number means that we have a net profit or net income. A negative number is going to tell you that you had a loss, meaning your amounts that you sold, the generated revenue, the income, when you sold your items, did not cover all the costs it took you to operate your business, okay? Now, I'm going to tell you this as a fair warning for most businesses. If you are planning to open up a small business as a mom and pop shop, right? General rule of thumb is usually the very first year or so, you will see losses because it takes a lot of expenses. You have to buy a lot of things in order to have your store readily available to sell your product. Okay? It costs a lot of money to even, get yourself started into a company, right? It's only slowly but surely you will gain your revenues based on your selling price, but also based on calculating that percentage of profit that you need to take in order to help cover all the costs. So, with that being said, that's just a little tangent, but a little FYI, if for small businesses, usually you will more likely see losses in the very beginning of your business versus any positive numbers. But in this case, if we do get a positive number, then yes, we got a net income or a net profit. All right. Now, positive is a good thing because as a sole proprietor, you have two options. One option is to, if you would like to, you can choose to take that profit and reinvest it into your company and have take that money and basically you can either invest it into your company to make it more profitable or make it more better, maybe get some more appliances, purchase more assets, whatever it is, right? Better your company. Or you can actually choose to pocket that money. Okay? Now, most sole proprietors, right? Best rule of thumb is as a small business owner, you don't want to cut yourself too short either. And you definitely don't want to be drowned yourself into too much debt. So the best option is that you should go forth and reinvest into your company. However, you do have the capability because you and the company are one. So you can take as much money as you'd like. You could take the profit and pocket it if you'd like. It's your business. It's your decision. However, most cases or recommended cases is you should reinvest into your company. So that's where we have here. So how are we going to do this? I'm going to walk through you guys one step at a time to be able to compute the income statement. We're going to start with our sales. We're going to subtract our cost of goods sold to get our gross profit. Then we're going to subtract all expenses that it took you to operate the business. So any operating expenses. And then if you have any other income or any non-operating expenses, those will be tallied at the bottom, and you're going to pretty much either add or subtract at this point. Okay, so again, revenues is your beginning. You're going to subtract your cost of goods sold, subtract your operating expenses, add any other income, and you'll get your ending number here. Okay. Once we do that, then we move on to the next statement, which is going to be the statement of owner's equity. Now, let me tell you, it is important that you go into this exact order because each statement that you produce is going to be dependent on the previous one. So in this case, right, we solved for our net income or net profit. So if we choose to reinvest into our company, this is where it affects the flow of or the value of your company, right? Is the statement of equity. So if you choose to invest your money, therefore you're going to add your net profit or subtract your net loss. Okay? Now, in this case, if you have a net loss, that goes directly onto the statement of equity because you can't out yourself money, right? You're not going to pay the money. You're going to just take it away from your company and have the company pay for it. All right. So that's one thing about losses there is it has to be immediately taken away from equity. However, net income or profits can be added in here if you choose to reinvest. But if you choose not to, then and you just want to pocket the profits, you generally do need to at least note that you're going to have it in there and just take the equity as an owner's withdrawal. So here you go, right? We talked about how what accounts affect owner's equity. So the statement of equity, right? We're going to start with our beginning balance. Then if we have a net income, then we're going to add into our equity. If we've done any capital contributions, like add our own money to invest in there, that's a capital contribution. So that will increase equity. Now, for any reason that you decide to withdraw from your company, that will decrease your equity. So in this case, we're going to subtract out any owner's withdrawal in this case. In this case, we don't have any. So we just reinvested our money into the company. So therefore, if I started out with $2,000 and I added my profit of $309, therefore my new equity as of the end of the month of June 30th is now going to reflect as $2,309.17. So once again, it's increased because I reinvested my money into the company. All right. So you need to produce the income statement first to determine whether you're going to invest or take a loss. All right, to adjust your equity. And then any contributing factors such as adding money or taking away money, you're gonna put that in here to calculate out what the value of company stands as of the end of the month. Okay. Once we do that, then the next step is to run your balance sheet. Now here, this is where you are going to be testing the accounting equation. Does your assets equal your liabilities plus your equity? All right. So this is where it's just like taking the trial balance, but we're not looking at debits equal credits. We're looking at does all of your assets equal your liabilities plus your equity. And in this case, my equity is going to be the new value of equity that I previously calculated in the statement of equity. All right, now do you see the connection that it's important that you do these in order? So here, it's important that I do that because now I don't need to solve for what my equity is. I just plug in the number that I solved in my previous worksheet, and basically I'm only tallying up my total liabilities and my total assets and combining them together to ensure that this statement is true, that my assets equal my liabilities and my equity. And if it does, then great. Then you are successfully okay, right? So here, my total assets is $2,309.17, and so is my liabilities plus my equity. Okay. Then we're going to come into another conclusion to complete the last statement of, which is a statement of cash flows, right? Where this one kind of tailors a lot of things, right? Most of these things that you see here are actually going to come from your balance sheet as well as your income statement, right? So at the very, very top, you're going to start off with recognizing what was your net income or your net loss for that month. And what you're going to do is, as we've mentioned it slightly before, we're going to go from an accrual basis and switch it into a cash basis to understand how much cash is flowing into the company and how much cash is flowing out to the company. So in this kind of way, how I explain it is that what we're doing is we're taking our balance sheet, right? Because our balance sheet should list us our current assets, our long-term assets, our other assets, and we have current liabilities and long-term liabilities, right? So by taking that idea, right, in this case, we're going to split them up and divide them against 3 categories. 1 is operating, 2 is investing, and 3 is financing. So how we understand it is that all of your current assets and your other assets and your current liabilities are all going to be under operating activities. All right. Now, when we actually dive into working on the worksheet, I'll go ahead and explain a little more on how to compute it. Because what we're looking here is how much money is actually flowing into the company. So if you have an accounts receivable, right, we have to understand it as if when we're putting into context of cash, right? Now, when we have accounts receivable, the question is, did you actually receive cash? In this case, accounts receivable are nothing but IOUs from customers, right? So in this case, we need to subtract it from our cash flows because that's money that we never even received. So once again, it's the idea of going from an accrual basis to cash basis to see how much cash really is flowing into your company versus the cash that's flowing out from your company. Okay. My investing activities are going to be your fixed assets. Okay. So fixed assets, think that you plan to purchase, whether it's the building, the equipment, machinery, in order to run the business, right? That's considered an investing activity because you're investing these types of equipment to help you to operate your business, but at the same time, these hold value because at the end of the day, if you don't want that machine, you can go out and sell it and get cash for it. All right, so that's the idea of investing. They hold some kind of value to your company because, they're things that you can sell right back out to the public. And then we have financing activities, which are usually going to be anything that is a long-term liability. So any money that you borrowed, like a loan, is going to be considered a financing activity, right? It helps you're borrowing money to finance your business, all right? And then at the very end, you're going to have two things that you need to know. You need to have the beginning balance of your bank account, and you're going to have the ending balance in your bank account. And what you're going to solve is that your whole entire worksheet here is that when you compute your financing activities, your operating, your investing activities, right? Once you get down to there, you're going to have what's called a change or a difference or a net in those things. And the difference between those two should be the difference between the beginning amount cash that you started with in the business versus your ending balance that you solved for in your when you run your adjusted trial balance and everything, right? That's going to be the last thing that you should have to show you the difference between them and where you stand in a cash type of basis kind of a company, right? How much cash is flowing in versus how much cash is flowing out. All right? So that's that statement. Once we've completed this, now we can officially start closing out our books, right? So if you guys remember, chapter 2, we talked about permanent accounts and temporary accounts. So this is where we finally get to understand why my accounts are permanent and why some of them are temporary. Once you reach the end of the given period, you are subject to have to close out your temporary accounts, which are your revenues, and your expenses out to the income summary, okay? Now, once we close it out to income summary, right, what does that mean? So in simplest terms, when we originally look at our revenues, right, we typically credit them the accounts, right, because that shows us that we're increasing our revenues, right? But in order to zero out each account, what you're going to do is you're going to journalize them and you're going to zero each account into the income summary flowing in the opposite direction. So in this case, in order to close out my revenues, I would have to debit all of my accounts because that's going to decrease every single one of them till I want them to become 0, and I'm going to go ahead and zero them out to income summary. All right? Same thing with my expenses, right? Normally I debit my expenses, but in order to zero out them, you're going to credit your expenses, and you're going to credit them out to the income summary. Now, once you've done that, what you're going to notice is that your income summary, so you're going to journalize it just like this, right? You're going to debit all your sales into the income summary, and you're going to credit all of your expenses to the income summary. And at the end of the day, your income summary is going to match whatever you solve for your income statement. So right here, my income statement told me that I had a profit of $309. There it is. There's your profit for $309.17. Okay? And the last step that you're going to do is you're going to zero out your income summary to your equity account. All right? And this right here is how you transfer the in this case, reinvest into the equity. This is the actual journal right here, is that you're going to do that by creating an income summary, which allows you to either debit or credit the equity account, right? So this is the proof of transaction that you're reinvesting into your company by doing this closing process. All right. And of course, you also have to close out any owner's withdrawal to your equity account as well. That's usually the other step 2, so you can properly record that you also took money out of the company, right? So that's that here. And once you've done this, once again, because we did a journal, we have to post it to our ledger. And when we post it to our ledger, that's where we must complete a post-closing trial balance. And here's the thing. By then, your equity should be here. You have no revenues, no expenses that you have to place in here. So the only thing that you'll have is basically all of your assets and all of your liabilities, because those are permanent accounts. Those never close out. And your equity account should be whatever your ledger shows. So you're going to run that just in case you made a mistake somewhere along the lines when you were zeroing out every single account. Right? And that is step 10, and that is the conclusion of your accounting cycle. All right? So here's a little review, right? We've already learned the first 4 steps so far, right? We've learned how to post to the journal. We learned how to post it to the general ledger. Now, when we complete our unadjusted trial balance, that's where we're going to go ahead and start going through the rest of the accounting cycle, all right? And this order is pertinent, okay? You need to keep them in order. Once again, here's a little review, right? When we look at trial balances, our main idea is to determine whether our total debits match our total credits. When we reach our closing process, we are looking at debiting our revenues, crediting our expenses into income summary, and then taking our income summary, and depending on whether it's a debit or credit, is going to determine whether you increase or decrease your equity. So you're going to close it out, that income summary, to your equity. And of course, here are the 4 financial statements and what the exact thing that you need here for in order to create them. Okay, so again, there they are. And I threw in a couple adjustment entries that are what we've learned in this class. Okay. So any questions about the closing process?